Everyone thinks the biggest mistake new investors make is choosing the wrong stock. But what if the real problem starts long before they ever click the buy button? What's the hidden psychological trap that quietly destroys more portfolios than bad investments ever do?
That's a great question, because the biggest mistake isn't a lack of knowledge, it's a lack of emotional control. Most beginners don't lose money because they're unintelligent. They lose because they let fear and excitement make decisions their strategy should be making. Think about it. A stock rises 40% in a month. Suddenly, social media is full of success stories. Friends start talking about easy profits. News headlines make it sound like everyone is getting rich except you. That feeling has a name: fear of missing out, or FOMO. Here's what's fascinating. The market doesn't know you're afraid. It doesn't know you're excited, but it rewards patience and punishes impulsive behavior with surprising consistency. Imagine walking into a supermarket where prices change every second. Would you panic because bananas became expensive for 5 minutes? Probably not. Yet many investors panic when quality investments temporarily fall in price. The psychology changes, even though the logic shouldn't. There's another trap that's even more dangerous: loss aversion. Research has consistently shown that people tend to feel the pain of losing more intensely than the joy of gaining. So instead of following a plan, many beginners sell winners too early to lock in profits, while stubbornly holding losing investments hoping they'll magically recover. But the real mistake goes deeper. New investors often believe successful investing is about predicting the future. It isn't. It's about managing yourself. The best investors know they won't always be right. Instead of chasing certainty, they build systems. They diversify. They think long-term. They accept temporary declines as part of the journey rather than proof they failed. Here's a simple real-life example. Imagine two friends each invest the same amount every month. The first checks prices every hour, constantly buys and sells, and reacts emotionally to every headline. The second follows a disciplined long-term plan and rarely changes course. 5 or 10 years later, it's often the calmer investor, not the smarter one, who ends up building more wealth. That's because investing is less like gambling and more like planting a tree. You don't dig it up every week to check whether the roots are growing. You water it, protect it, and give it time. Patience is an investment strategy, not just a personality trait. If you want to improve your returns, spend less time trying to predict the market and more time understanding your own reactions. Master your emotions before you try to master investing, because markets reward discipline far longer than they reward excitement.
That's a perspective every investor should remember. The market isn't just testing your money, it's testing your mindset. Thanks for listening. And remember, the strongest portfolio often begins with the strongest psychology.